Everybody looks at gold like it's going to follow this data point or that. No, it doesn't. It leads the data points. It anticipates the data points. And the central banks are a key data point because they're the ones who destroy the money units.
Michael Oliver, how are you?
I'm fine, Andy. How are you doing?
I'm doing good. A lot of stuff going on. We were having everything rip. Gold has been very volatile last couple of days, or I should say last couple of weeks. Let's start with that. Talk to me about gold.
Sure. When we measure markets at Momentum Structural Analysis, we look secondarily at price charts. And we know everybody out there looks at price charts. Okay, that's a reality. But the problem with price usually is that when it's ready to change trend, you don't see it coming necessarily. Whereas price usually looks absolutely great at the top or absolutely looks like hell at the bottom, and so it doesn't warn you that, hey, this is the bottom. Okay. It's only later, maybe 20% off the low or off the high, you finally realize, ooh, that was it. What we examine is price's relationship to certain long-term moving averages. And I don't mean whether it's above them or below them. That's not an issue for us. How they overlay moving averages, that's irrelevant. You can crisscross averages all day long. Sometimes it means something, sometimes it's not. What we do is we oscillate price versus the moving average. So if we want a long-term picture of gold, for example, back in the 2011 peak, when gold hit 1920, it was in like October of 2011, bull peak, it dropped down into the 1600s, rebounded back, and in January of 2012, literally 3 months off the high, we turned mega bearish. And yet the price chart, a little stumbled, went back up again. Not a new high, went back up. And for a year, it waffled up there, feeling good, steady. Never went back to the high, but it felt steady. Our annual momentum said, no good, it's going to be a bear. Well, it took it till the spring of 2013 to finally effectively crash. You went from like 1600s down to 1200s, very rapidly. And finally, you bottomed at what? Late 2015, gold made a low at 1,050 in December 2015. 2 months after that low, February 2016, our annual momentum of gold, not price, broke out of a massive, very clear basing pattern that you could not see on the price chart. Price was zigzagging down, momentum built this base. We broke out of that. Now, ever since that buy signal, nothing gold has done on the downside. We've been in a lot of sell-offs. In fact, we had a 22% sell-off between the March 2022 high and the September 22 low last year. It was 22% drop. Intraday high, intraday low. There are a lot of other drops along the way over the last 8 years that have been, 10, 15%ers. None of them change the annual momentum trend assessment that we had. It remained positive despite these sharp zigzags, which impressed everybody. Everybody, oh my God, gold's over with. Every time it turns down, gold's over with. What just happened 2 weeks ago, gold went up to the old highs that we saw in 2020, 2022, and early this year, all above $2,050 US. Couldn't get to 2,100. Sold it off again from the March high this year down to the low 1800s, 1820 something, I think. When it came up off that low, got in the 1860s, we said, okay, this is over with. The downside, the process, the arm wrestling we had for 6-7 months was over. Just a corrective pullback, again, from that flat price high. The problem was what happened recently was we went up and took out those highs, but it's so, bleeding obvious to anybody with a price chart that if you were a deeply entrenched bear and you wanted a protective stop, what would you do? You put your buy stop at 2,100. Or if you were a lagged bull that needed to have that proof of breaking out over the 2,100 level, you had a buy stop there. So in the dark on Sunday night, December 3rd, in the dark, electronic trading, you went up, hit 2,100 and went boom to 2,150 in a heartbeat. What happened there? Well, what happened was you hit all the buy stops. Okay. And you created a void. In other words, you exhausted the buy order. And you had 48,000 contracts trade within that hour. It's like a record. Okay. And then, as I understand, and my son has researched this, that in fact it's the case, the Bank of International Settlements came in and dumped some gold there when we got up to 2150. So, whether that's manipulation or well, let's ignore that. But they sold there. But the problem was you just exhausted all the buy orders below. I mean, there was like nothing, so you probably could have shorted 10 contracts and had gold drop $50 because all the buy tickets just got blown. So at least the first 50 or so dollars was a void. And sure enough, it came back down, even got under 2000 this week, got down to 1987. Then we zoomed back up within one day into the 2060 level yesterday. And today we're around there too. I think that low was it. It was just a volatile, price-based, stupid situation where if you thought you could buy at 2100 and get rich, you're buying late and you're buying with every other idiot who's covering his short position and going long late in the game. Okay. So you got this turbulence and everybody go, oh my God, gold's top again. Okay. We don't see any evidence of that in momentum. I think gold is about to enter what it normally does late in bull trends. Remember, this is 8 years old already. 2015 low, 2023, 8 years inclusive. Is that gold accelerates in its final year or so of bull trend in a big way to where most of what you gain in the overall bull trend is compressed in time, like in the last year. You go back, want another example, go back and look at 1974 through 75. Gold came up from the 30s and suddenly it was 200, most of that in the tail end. Then you look at the bull trend that peaked in 1980 after multiple.
I remember that.
Yeah. Where did most of the action occur? 1979.
79, yeah.
Yeah, literally a few quarters before the January peak in 1980. You went from like a couple $100 to 850, boom, boom. So it was all compressed late. Now, that fits with the notion of the chaos theory. When you get an incremental arm wrestling trend, but suddenly things aren't really where they ought to be. So the market says, damn it, I'm going there. And it does it. And it does it in a whoosh. And it's shocking. And I think we're facing that pivot point right now where we're about to go from this arm wrestling nonsense for the last 8 years, $100, $200 drops, $300 drops, et cetera. Sometimes in 2 weeks, you drop a couple $100. Remember March 2020? Gold was up 16, 1700. Next thing you know, you're in the 1400s. A few weeks later, you're making new highs again. Okay. So I think that process is about to wrap up and we're about to go into the accelerated phase.
So let's talk about that. Yeah, I want to comment about that. And also what you just said, just from my experience, if you would, and confirm this, if this is what you see or this sounds like what you're saying, is typically in a big move. It can be also down, but typically in a big move, volatility increases exponentially. Am I wrong in saying that?
No, that's correct. Yeah.
Got it. Okay.
To be expected.
To be expected. So you're expecting, from what you're telling me, is you're expecting pretty significant upside.
Primarily upside this time. Yeah.
Primarily upside. Okay. Yeah. Do you have any kind of, or do your indicators give you any kind of ETA? And that's a really tough question.
I'm going to guess that once, and it's based on historical, not just what gold's done over the last 50 years in terms of how did its bull markets behave. But it's true with many markets, particularly commodity type markets, where you late in the move, you get the verticality. Or late in the move, you get the collapse. Instead of arm wrestling decline, you get a puke. Okay. I think we're going to see that soon. And I think one of the pieces of evidence of that, if you just look at a price chart now, would be the people who thought the breakout over 2100 was false because it fell back down for the reasons I discussed. You get back up there again over the next couple of weeks, let's say get to 2100 again. In other words, back above the 2020 high, the 2022 high, and the early 2023 price high. So the 2050, but not 2100. You get back up there again, people are going to say, well, it wasn't a top. They've said this repeatedly. Oh, it's a top. Oh, no, it's not. Okay. And all during this 8 years, we've had that process. But this time, I think once you do that again and go back up to that 2100 and touch it, I think at that point, people will realize, golly, it's just volatility. We've been stressing this in our reports. In fact, we sent out a price chart of gold going back to 2015 a few days ago just to make the point. Circled all the drops, defined their percent decline, how fast it was, and they're all meaningless. And yet they shook people out all the way up. And so the guy who basically sat back, smoking his cigar, whatever, and got in at a good time, like in early 2016, which is our primary buy point, and basically just sat back and ignored the day to day, even the week to week, but just looked monthly closes. Oh, okay, you had a down month. Okay. But basically sat back and relaxed. He's caught the whole thing and he's still relaxed. It's the people that focus in on the day trader type elements. They can whipsaw it in and out, and they never catch the move. It's just by the nature of the market. They'll get whipped out and they won't get back in one time and they'll finally miss it. It's also at that point that we've seen something else happen for gold and related, the monetary metals, especially for silver. If you go back and look at, let's say, the 1976 low in gold, which was at just above 100 after having been at 200 in 1975, and watch the process upward from that $103 low in August of 1976 up to the January 1980 high, and look at the arm wrestling price action of gold, and then it exploded. And look at silver action at the same time, and you'll find that during that incremental phase of the bull, first couple of years of that, silver was mucky. Yeah, it was generally rising with gold, but it certainly wasn't outperforming. And it would whip you more than gold would. It would be stronger in the surges and then weaker in the pullbacks. We see that all the time. It was at the tail end of that bull move, like in 1979, silver beat the pants off of gold. It went so vertical that, you could have shorted gold, bought silver, made a ton. Yeah. Same was true in the 2000 bull to the 2011 bull top. If you look at that action, the first 6, 7, 8 years was arm wrestling, even for gold and for silver as well. It was in that last year, especially 2010, silver went ballistic relative to gold. So not only was it the last phase of the bull market where you went dynamic in net price, but on a relative performance basis, that's when silver jumped in front of gold and beat it hugely on a percentage basis. You can say basically the same thing about the miners. Now,
I wanted to get to that. What about the miners? They're significantly, which is odd, they're significantly underperforming the price of the metals. So yeah, I'm very curious to hear your comments on that.
That's a true statement you just made, but it's only true if you go back to 2020, 2021 highs in, for example, the GDX ETF and decline it's had. We're not back at the highs gold is. So you say, it's vastly underperforming gold.
Right.
But if you go back and measure where GDX was at the bear lows in 2015, it's slightly beating gold, even with this pullback of the last few years. So GDX is at a higher percentage gain than its bear low in 2015 than gold, despite that underperformance in the last couple of years. So we can flip-flop. Now, even Newmont, for example, if you look at a Newmont chart, the big blue chips, Newmont and Barrick, and look at the high we made a year ago. Newmont has collapsed basically relative to that high. But right now, at current prices,
I know
Newmont is 148%, or 140 plus percent of where it was at the 2015 low, whereas gold's only double. So even with the giant pullback, Newmont, from an investment grade point of view, is still beating gold.
So it is true.
Yeah, no, but there'll be a point at which what happened from 2001, 2000 peaks in the miners and then the pullback will be erased, and they'll outperform gold again dramatically. And I suspect that will probably be coincidental with silver reasserting itself versus gold on a spread basis. So I think that's right around the corner, by the way.
Very interesting. Well, let's talk about oil. It's been beaten up recently. We had a good run up during the summer. Then we sold off which was surprising to me, the violence of it during the fall. What are your indicators telling you about oil?
We judge oil also in its relationship to the overall commodity complex. Okay,
We'll talk about that. Yeah.
Measure Bloomberg Commodity Index, which is a fairly well-balanced commodity index. There's others that are very heavily weighted in oil and natural gas, too heavily weighted in our view. So that basically those indexes of commodities reflect oil. Okay. But the Bloomberg is fairly well balanced. We called the bottom in the Bloomberg Commodity Index in October of 2020. That's several months after its bear low. And the bear low in the Bloomberg is like $58. It had been as high as 237 in 2008 at its peak. And at its secondary peak in 2011, when it was coincidental high with gold, it was a lower high for Bloomberg. It was in the 170s. It then dropped down into the under 60 by mid 2020. Now, during all this period of time, what was gold doing? Doubling in price, while Bloomberg was continuing down from 2015 to 2020. So it didn't correlate to gold. Gold had doubled, Bloomberg had continued to erode. When we called that low at a price of 70 in the Bloomberg, it went to 140 by early 2022. Oil led the pack. Oil and natural gas on a percentage basis were definitely the leaders of that commodity complex. You could have thrown a dart, bought any commodity and made money, but
Right.
oil and natural gas beat the pants off everything. We don't think they'll be the leaders in the next leg. Yes, I think they'll go back up, but I don't think on a percent basis they'll beat, for example, we think the grains will beat them this time. But oil right now in the waddling around in the $70 zone. It's even nipped below there. We had a recent rally where we thought it would get to 95 or 100, got up to 95 and 10 or something and collapsed. Okay.
Yeah.
It was just a trading rally. We think basically from an investment grade point of view, meaning if you don't care if you're going to lose another $5 or so, okay, you could probably buy oil here. You may have to sit on it for a while, but it may go lower. I don't think you're going to go substantially lower. It's been again in the high 60s. So, it's not a big deal if it got there again. We think oil is probably basing out here. Same with natural gas, which we'd projected in our bull call. We bought it at $2. We thought it'd go to 9. It went to 10. Now we're down in the twos again. It's a wipeout for that commodity. Probably you're looking at a zone of a bottom. But again, I don't think the dynamics on a percent basis will beat certain other commodities, which did not lead that first commodity up leg. I think they'll lead the next one. I think it'll rotate over to the grains, which of course is very painful for a lot of people. It was painful to high gasoline prices. It'll also be painful if grains go up.
Yeah. We'll talk about grains. What makes you think that? And that's very interesting. Very interesting to me. So
Not fundamental. Okay. We don't look at the fundamentals. I mean, we were aware, but if you look at that, it sometimes could be vastly misled. We measure wheat, corn, and beans via certain long-term metrics and short-term, but especially our long-term metrics like what we call quarterly momentum, where we measure each monthly bar, wheat, corn, soybeans, in its relationship to, in other words, oscillated versus the 3-quarter moving average. So is it above it or below it? We plot it on an oscillator. When you look at a price chart of wheat or beans or corn, you see this sharp down again since the 2022 high, and then this more gradual process that's persisted for the last year, where they just keep arm wrestling it lower, not collapsing, just, arm wrestling. But when you look at momentum, you see a clear base. There's momentum says, I'm bottoming. Okay. And there's structures overhead on momentum where if you looked at the momentum chart, you'd say, oh, I'm going to put my buy stop there because this is a ceiling that we've hit and hit and hit. Don't see it on the price chart. It won't take a lot starting next quarter with a further drop in the 3-quarter average of corn, beans, and wheat to go up and break through that barrier. And momentum will then say, okay, bull is back on again. And the nature of those structures looks potent enough. Whereas if you looked at them as a price chart, you say, that's a potent base, okay? You'd be impressed. Where they'll take over leadership, I think, in the next upside in commodities on a percentage gain basis. And I'm going to suspect it occurs next quarter. And it won't take a lot of rally to get there.
it sounds like it's all setting up for next quarter. What I mean, gold, also energy, which you think is going to, relative to gold and grains, is going to be strong, but not as strong.
But gold will lead. Gold will lead the whole commodity, just like it did in the late 70s.
It's interesting too, because your indicators in your projections are setting up really well not that you follow this, but what's going on in the news as far as just the Fed they're coming out dovish and so on. It's setting up really well for this. And I had a hunch, and again,
Mm-hmm.
this is the first time we've talked about this. Is I was thinking that I think we're going to have some big moves in the spring, and you're just confirming that to me.
What really drives gold over the long term are monetary factors. It's money,
Right.
competing money to paper money. It's been so for 3,000 years. Okay. And, you talk about a mature market that knows things. There's one that knows things. Okay. It's a wise market. Everybody looks at gold like it's going to follow this data point or that. No, it doesn't. It leads the data points. It anticipates the data points. And the central banks are a key data point because they're the ones who destroy the money units. And you go back and everybody thinks, if the stock market goes down or we go into recession, gold's going down too. That's baloney. It's historically not true. Everybody only remembers 1 month, and it was October of 2008, when the gold had been going up since 2000, when the stock market peaked in the year 2000. Stock market collapsed through 2002. Gold was going up all during that time. And gold continued up through 2011. But there was that point in 2008 when the stock market was already a year off its high and well off its high. And it had a collapse month in October 2008, a year after its peak in October 2007. Gold finally said, I'll join that. And so all everybody remembers about the so-called correlation between stock direction and gold direction is that 1 month. And even then, the stock market continued lower until March of 2009, whereas gold after that October break was back to its highs so quickly. It was making new highs before the stock market could even get get its footing again. So anyway, when the Fed panics and Fed alters what had been a tighter monetary policy, and they either go flat, and everybody knows they're not going to raise anymore. All the experts are only debating about when they're going to cut. That is a negative signal for the stock market. It was in 2000. They quit raising rates in May. We got bearish in January 2000. We said major top in the process. It might make a new high, but this is a top. Okay. Sure enough, it made a new high in March, and then in August, Fed ceased raising rates in May of 2000 after a couple of years of rise. In January, first days of trading of 2001, S&P was marginally off its high, wasn't in collapse mode. People didn't realize it was a bear yet. The Fed started drastically cutting rates. That's when the stock market started to collapse. Same in 2007. They've been raising rates up through 2006. In September, mid to late September 2007, about 4 weeks before top tick, they cut rates by 0.5 basis point. If you'd have sold that first rate cut, you'd have effectively nailed the high. And they cut rates all the way down and the stock market collapsed. Who was the beneficiary of the easy money? Monetary metals. This time the bubble is bigger than we've ever seen, stock market bubble. So when it breaks, the errors that will be exposed, fundamental data points, etc., which will follow the market, not lead the market down. The Fed will have full justification to shift their academic policy the other way, and they know it. And what's really spooked them, and what I think has helped gold lately, was the crash in the bond market. We had a crash this summer. We call it a nuke event was about to occur. And the T-bond market, the most precious market to the Treasury Department and the Fed, went into crash-type decline. It wasn't even reflected by like muni bonds or high-yield corporate debt. They didn't blast out the October 2022 low, but the T-bonds crashed through last year's low dramatically. It looked like some collapsing commodity, like limit down type stuff, And we knew that would cause a panic. And sure enough, I suspect, I can't prove it, that in the dark, Treasury and the Fed were buying T-bonds like crazy. And a lot of large asset managers, I suspect, were too, if they were smart, because technically it justified a full V bottom, which we're getting.
Yeah.
And what is that? The point being here, that is the biggest panic data point for the Fed, not some CPI or monthly data that comes out from some government agency. I don't know what the reliability of it, but that T-bond crash scared them to death. because that was not part of their process. They were playing incremental games. T-bond market literally started behaving like the Bank of Japan's, like the Japanese bonds. It scared the hell out of them.
Got it.
And therefore, beneficiary, gold.
Well, about gold. So do you have a projected price then in the next several months or years? I mean,
No,
it's putting you on the spot here.
I will give you some history, and your listeners can digest it if they want. The two prior bull markets are a couple. If you want, you can break up the 1970 to 1980 bull as either one bull market or two segments. But either case, 8-fold moves in gold over multi-year periods from bear low to bull high have been common over the last 50 years. There's like 3 of them. Went from the $30 level to 200 by 1975. And then if you want to start over again in 76 low, you were 103, you went to 850. Well, what's our bear low? 1,050. We're only double. If gold merely replicates what it's done before, just another, 8-fold move, it's almost routine. Be $8,000 gold. And that's not saying something outlandish. I'm just saying, what if it does it again? Okay. Well, we have the factors out there like we've never seen before. That, I'm not going to say you're just going to have a replicated move of the other bulls, 8-fold move. I don't know. I think a lot of stuff's going to happen. Big stuff in a lot of markets that will impact gold and therefore impact. Like if you have the stock market rollover, which we think it's going to do, we think it topped in 2022. Even if it makes a marginal new high, I don't care. It made marginal new highs in 2007 after we declared bear. It made marginal new highs in 2000 after we declared bear, but it didn't sustain. Right now, the S&P is trading around 4,700. You drop back down much under 4,400. Anytime next quarter or next year, assume it's over. That you're going to blow out the bear lows at 3,500 that occurred in 2020. The problem with that is all of the data points are going to start to follow it. The stuff the Fed likes to tout. Okay. Excuses for soft money. But the problem is this bull was 12 years old, like 3 times the age of any other bull market. S&P went up 7-fold. NASDAQ went up 16-fold. There's no bull market in U.S. history that compares to that inflated asset bubble. And we know what caused it. Fed funds went to zero, effectively free money for 12 years. It's like taking drugs, okay? And a lot of errors were made during that time. And also the money supply exploded over the prior 10 years versus any other 10-year period. So we understand why the market went up. But the problem is when it breaks, all the errors that were built into that will be exposed. And the Fed will have to panic to try to save certain assets, particularly their bond market. Beneficiary, gold.
Michael, what's the saying? We live in interesting times.
Absolutely. More than any time in my life. Good question.
So if somebody wants to get in touch with you or use your services, how do they do that?
It's Oliver MSA for momentumstructuralanalysis.com. Oliver MSA. You go there to look under who we are. You get my picture, and below my picture is an email address. Click on it. I'll send you sample copies.
Excellent. And I'll put all of this in the show notes. Michael Oliver, it's been quite a pleasure. I want to thank you so much. I do admire your work greatly, and it's great to get you on.
Thank you, Andy.
All right. Have a good day.